Good morning. This is Vince Lanci. It is 8:02 on December 19th, Fed Day, the much ballyhooed, uh, 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 poorly understood, I think, by many people, implications, the present as well as the future matter in these things. And we're going to spend almost all of our time on uh, uh, thinking like a trader thinks, not predicting. Traders that do predict, they're putting on bets. We don't bet, we trade and we handicap probabilities. So we're going to be attempting to focus on two concepts. One is going through, I guess, permutations or the different things that the Fed could do today. There's three different potential outcomes that I know of, and how the markets are likely to react given each potential outcome. And helping me go through that will be some analysis by an FX guy who I recommend following. But today he's actually very good because he augments what I believe as well as throws a fly in the ointment of my own biases. So before we do that, let's look at gold. This is the spot chart. Now, people trade futures, especially in the U.S. Okay, so but I use the gold spot market because that is the cash market, and that's more important to me than futures. But that's not where I express my trades. The difference between gold spot, right, and gold GC1. If you look on the right hand side of my screen there, if my arrow is showing up, is GC1 is the continuous gold front month future. In this case, it's February right now. The reason on this display, my gold future is delayed, so it's 10 minutes behind. So if you use software like this, and I don't use software like this for trading, I use it because it gives me nice technicals and charts. If you use software like this for trading or for your own analysis, and believe it or not, it's not free. There are ways other than knowing what the market's about to discern the difference between spot and the front month, and that's what's known as the EFP, or the difference between spot and front month futures is called the exchange for physical. And if you Google that, you'll find that there's a lot of controversy about how the EFP has been used in the past or maybe in the future and present for distorting legitimate volumes. But right now, the gold market is trading down $1.85. Now that's spot gold that closes at 5 p.m. Okay, gold futures are trading. February futures are trading 12.51 spot 30, down $2 from the 5 p.m. close, not the 1:30 p.m. close that'll hit your statement. So this uses the Globex close, not the 1:30 p.m. for settlement close. So the market is in a different place than that. The spread between gold and gold futures, your EFP, is approximately $5. And I can show you how to interpolate that another time. But right now we're looking at, and we're going to focus on what the Fed may do and how the markets are likely to react to that. And for today, when I say gold, you can probably substitute the S&P because we're talking about tightening monetary policy versus not tightening monetary policy. And gold and stocks would move together. So, if interest rates went to zero, opportunity cost of money goes to zero. Everybody puts their money in stocks and gold goes up because the dollar weakens. If interest rates were to go to infinity, gold would go to zero because you couldn't afford to buy any or borrow any on leverage, and stocks would go to zero. So that's what we're looking at here. Stocks and gold are pretty much should be lockstep today. And gold is not a predictor of markets like the bond of the future, like the bond market is. If the bond market can look down the road 6 months, and the stock market can on average look down the road 2 months, the gold market looks down the road 5 minutes ago, meaning it reacts. It's not proactive. All right, so here's the market right now. Okay, and I want to look at the February future just quickly. There's a lot of lines there, so why don't we hide those and just show you this on a daily basis? Okay, this is where gold is right now. Okay, I have a proprietary system called VBS, which handicaps breakouts. So the market, uh, for my system here on a daily basis, does not show a breakout as imminent. Okay, that's not a technical system. On the 4 hour, it says we're in a retracement. There is no momentum, and on the hourly, it says we are not showing momentum lower, although we are going lower. But let's move to uh, uh, the Fed. Okay, and then we'll do technicals. Okay, and then we'll talk about a little bit more about the correlation. The information I'm using here is from a guy named Mark Chandler. There's plenty of stuff out there. I like the way he writes. I like the way many people write, but for today, I like the way he writes because he writes like traders think. And a trader should not, and this is my opinion, right? But my opinion's pretty good on this stuff. A trader should not be thinking uh, uh, of direction with absolute mentality. Trading is not like running a business in the sense that running a business, you have a philosophy and you have a business model and you run with it. Trading, you have to be very flexible, and therefore you're actually given to using conditional probabilities and inductive logic. Okay, preamble over. Let's read this and go through it. The FOMC meeting is front and center today. The broad call for, and there's some typos here I'll help you out with. The broad call for the Fed to be less forceful in raising rates next year and being more flexible and data dependent is hardly controversial. That statement basically says that what I agree with is that, broadly speaking, in the markets, professionals are uh, uh, expecting or calling for the Fed to be less stringent in its QT, quantitative tightening, which is, you can substitute the word raising rates just for this conversation, even though it's a simplification. They want the Fed to be less forceful in raising rates next year and more flexible. Now, and more flexible and data dependent is hardly controversial, meaning people talk about that. So before we even read the next line, I want to just hit you with these three things. If you have a pen and paper and you want to write it down, there are, and I may change this as we go through the conversation, as I learn, because it's empirical information. There are, I think, three likely choices, three of the most probable choices today, or outcomes today from the Fed conversation are: one, and I'm not ranking them in probability, I'm just giving them to you. One, the Fed hikes and gives no indication that they're going to lessen their path of a projected 3 hikes of next year. Two, the Fed hikes and gives uh, an ambiguously soft statement. Actually, there's way more than three, and gives a soft statement that they reserve the right to back off on hiking rates next year. Three, the Fed hikes and makes a definitive statement that they're going to back off on hiking next year. Four, the Fed doesn't hike, reserving, and qualifies that by saying we reserve the right to hike next year. Now, I'm going to go through my process on that. I may forget my own order, but the first one was the Fed hikes and gives and speaks in absolute terms that they are not changing their bias towards 3 hikes for next year. So when you're listening to the Fed, two things: the market usually discounts what the Fed's going to do pretty well. What the market has as an unknown is what the Fed's bias for the future is, and that comes out in the wording. And if you're old enough, you remember Greenspan. He was very good at telling you a lot of nothing. Yellen was mediocre at telling you nothing. Bernanke was, I don't know what he was, but Powell is carefully ambiguous. I don't think he's very sloppy. So if the Fed were to hike and say they have absolutely no bias, no change in bias to raising rates next year 3 times, which is what's on their agenda, the wording would be something like this. The economy, the wording would be something like, we're raising rates 25 basis points, the economy's robust, and we are data dependent, and that's not, you know, that's not a dodgy statement. We're data dependent, and until that data says that we're at our neutral target, whatever their neutral target is, we're not going to get into questioning them. We're going to continue on the path. All right, that would be a hard line statement. Okay, I think the probability of that happening, a hike and a hardline statement, are very low in combination. By nature, they don't make black and white didactic statements because they might regret them later. Think of how a lawyer talks. All right. The second one, I think, if I remember correctly, was hike, and I think my voice is cracking. Hike and reserve the right, or hint that you are thinking about being less uh, 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 aggressive on raising rates next year. That phrasing could be something like this: we're hiking, um, uh, and they don't say anything about changing their policy. He says something like this, and I could be wrong, but this is an example. He says something like, we are much closer, and this is a phrase they've been using a lot lately. We are close, we are not close, we are far away, we're almost there, to our neutral or our new normal or our normative level, which is a mystery because they really don't know what it is. But I'll keep the editorial comments to a minimum, or the footnotes to a minimum. So if they're going to hike, if he says he's going to hike and wants to convey that they reserve the right to back off next year, that it's on their radar to back off next year, as opposed to the fact that they haven't said that they would be backing off at all in any way, shape, or form. It would come out something like, we're hiking, and we're very close to being neutral. And the next quarter, he wouldn't even say the next quarter. They don't put time frames on it. We're very close to our neutral thing. And unless there's an unforeseen surprise, I think we could achieve our goal very soon. Okay, that, I think the possibility of that is, I'm just going to go low, medium, high. Okay, hike and absolute bias statement number one, low for him to come out and say that. Hike and reserve the right to back off on QT, medium to high. All right, this is going to add up to probably 200% the way I talk. All right, third scenario: hike and an absolute, an almost absolute statement, or let's just say this: uh, uh, a preponderance of information, evidence that says they're not hiking next year. That would be something like this: uh, we're hiking 25 points, and we believe that this rate hike uh, brings us to our neutral rate, and the economy, et cetera, et cetera, et cetera. While we still are leaning towards, it's just a matter of phrasing. While we're still leaning towards, while by no means are we off our agenda of 3 rate hikes next year, but we would look at X, Y, and Z. That's someone who's saying, if you're trying to parse the words, that's someone who's saying, we're pretty close to saying, we're almost conveying that unless the stock market goes to infinity, we're not gonna raise rates again. The word in any politician or someone who needs to be careful and who's trying not to move markets inadvertently, the key word is but. Anyone who says something, anyone, okay, be careful, people use generalities like me, all right? But when a person uses the word but, frequently what they're saying is, everything I said before the word but, you can forget. So I think that is an ugly hat. No, I'm sorry. I think, wait, I think you're good looking, but your hair is a mess. Okay, when you say the word "but," I always thought it means behold the underlying truth. So I think you're good looking, but here comes the reality. The reality is, I think you're ugly. So "but" is a word that people should key on, and people do key on when they're looking at analysis, or when they're trying to parse people's words. So the third situation, which was hike and uh, uh, a very strong indication that they're going to end hikes next year, is, I think, low to medium as opposed to medium to high probability. Okay. The fourth, and we're going to lump them all in, there's many more, but we're going to lump them all in with the fourth, is no hike. All right. I think the probability of this is low. Now, this is my trading sheet. I think when you look at Powell's history and you understand the man, uh, 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 I'm not saying I understand man, but I understand his behavior. He is data dependent. Yellen was data dependent. Yellen was data dependent. She was only looking at the data that mattered to her, which was jobs. She wanted to get unemployment rate down. Powell is data dependent, but he seems to only be focusing on risk of inflation and an overheated economy. Now, so everyone's data dependent until it's not important anymore. So data dependent means the economy is doing well, the stock market's off. I'm looking at the data, so I don't care about stock market prices, and that's all well and good. But even Powell has a level in the stock market that he knows if the stock market is a tail on the economy and the economy is a dog, then there is a price in the stock market where liquidity freezes up, capital flows stop happening, and that itself affects the economy. Stock prices go low enough, okay, that affects the economy in a back. There's a phrase for it, a back loop, or a tail wagging the dog is a bad phrase, but the point is this: you can be data dependent all you want. What if the data is wrong? Because the market, and I believe this, is never wrong. So it depends on your time frame. So from my point of view, my opinion is, and this is my bias for my short-term trading, is I believe that this Powell put that everybody talks about, the Yellen put, the Bernanke put, the Powell put is somewhere around 2,000 in the S&P, in my opinion. All right, and that's not based on math. That's based on me looking at the market saying, oh, we're off 12% off of all-time highs. Can you really, if Powell really is the man he says he is, he's not going to stop raising rates because we're 12% off of all-time highs when we're flat for the year or down 3% for the year. He's going to do his job. He's going to do Volcker Light, and that's his job. But to acknowledge my own bias, he's got plenty of cover now to save face. Let's say he's got a big ego and he's defying Trump. Let's just say he's a human being, right? Trump is pushing him, and that only makes people not want to listen. So the Fed, which is independent. We'll put that in quotes, but they are independent from the other branches. They are a branch of the government almost. The Fed operates independently, but Powell's a human being, and if Powell has the cover of oil dropping, so that's an inflationary pressure off right there. And this is my opinion, but we're going to counter that in a second. And the global economies are slowing down, and houses are dropping in price. He's got legitimate cover to come out there and he's not going to, but he's got legitimate cover to come out there and say, inflationary pressures have backed off significantly. I see no need for a hike. But he ain't going to do that because that's a complete flip flop. These people, just like stock analysts, don't go from my target is 300 to my target is 100 when the stock drops $100 from 250 to 150. They go, oh, we're lowering our target to 250, and they gradually converge with the actual market price. So the takeaway from this is this: even if Powell wants to not hike today, again, my opinion, probably my strongest opinion, I don't think he can. He has to hike today. Even if he doesn't want to hike, he has to hike today. There's too much behind it: his credibility, his independence, his legitimacy. If he doesn't want to hike going into next year and he sees the data that shows him that, he's going to start putting out other Fed people to jawbone it and see how the market reacts. Other Fed governors will speak about that. So of the four, and there's a fifth one, right? Here's your black swan. He doesn't raise it 25 basis points. He raises it 50 basis points and says simultaneously, no more hikes next year. That's that. It's not a black swan because I just said it, but think about that. If he's scheduled to raise 25 basis points and he comes out and he says, I'm going to raise it 50 basis points and I'm not going to raise for the first quarter next year, what does that do to the market? That's the crazy thing. Those are things that I think about. Uh, uh, but the goal of the Fed is to reduce volatility, even if it's not a stated mandate. So let's go through what the markets can do, ignoring what they've done already. And let's go through that by reading the rest of this article here. Okay. Okay. The Fed has indicated through its forecast that it intended on raising rates 3 times next year rather than 4 and anticipated for this year. That's right. They're already backing off on their rate. They're already tapering on their rate hikes. That implies a slower pace than once a quarter. Right. They've already done that. This coupled with press conferences after every meeting already imply greater flexibility. These combined with the maturing business cycle and the proximity of the Fed's targets implies greater data dependency than may have been evident. What he's saying here is he doesn't see any reason for the Fed to change. Okay. Now, let's go through a couple other things. Many observers, and you'll hear these arguments, and here's a counter argument for it. Many observers who argue that the Fed should not raise rates note that price pressures are moderating. He's talking about guys like me here, what I just said, are moderating, not rising, and that the decline in oil prices is deflationary. That's basically what I just said. He's got cover to not raise rates or to back off in next year. But read this. With full employment and the economy growing above trend, folks, even as it slows from the unreasonably strong 4.2% annualized pace in Q2, a monetary setting that has the real Fed funds target rate at 0 is not appropriate. The point that someone made recently was, I forget, it was an economist, it might have been Rosenberg, who said, if I told you that we've been in a 10-year bull market and unemployment was 3% and our GDP was 4% last quarter, where do you think rates would be? And the answer, I think the mean answer was like 7%. And that's the point. We are not at a normal level. So back to the text here. Fed funds target rate at 0 is not appropriate anymore. Okay. The drop in oil prices. Now, this is him countering, this is Mark Chandler, countering my oil as deflationary comment. The drop in oil prices will hurt CapEx that has become dependent on the sector, meaning the drop in oil prices is going to make capital expenditures, because free cash flow will be lower, that's dependent on the sector, which is already leveraged, decrease. That's good, okay? But for oil consumers, high oil prices can be viewed as a tax on a consumer, a regressive tax. But for oil consumers, which includes households, the decline in oil prices will boost disposable income, which means consumption. Check this out. He's saying, Mark is making the case, and you can make the case, and you'd be right. But by lowering the price of oil and by lowering the price of energy-related products, you have more disposable cash in a person's purse. Okay, that means they're going to spend more. That's going to give you price inflation. That's very important. So you should read this. I'm going to have to cut myself short because I don't want to run into the 8:30 a.m. roadmap where Larry's going to get into handicapping the market as well. But I want you to note this now, and I didn't get to it, but it's kind of like this. I think in most scenarios, the stock market sells off. In at least one scenario, the stock market sells off and rallies. uh, as people digest things. Uh, but I'm flexible, and the words that I told you are my ideas of words that he could use. They're not necessarily the words he does use. He can go with a phrase that I haven't heard before. Like when he starts talking about dot plots, my head spins. But you should take a look at this, and review this before. And but down at the bottom, a dovish hike seems to be the most widely expected outcome, and that still leaves room for buy the rumor and sell the type of activity. That statement, if it's confusing to you, don't feel bad, because it was to me for a minute. A dovish hike seems to be most widely expected outcome, which is uh, uh, scenario number two. We're going to raise rates, and we reserve the right to stop raising rates next year. That's a dovish hike. Or we're going to raise rates and not raise rates next year at all. Um, uh, which leaves room for buy the rumor, sell the fact type of activity. Meaning, even if he does something like that, the market could sell off. Where's the buy the rumor? Well, the buy the rumor was before. Uh, uh, Point is, we'd be even lower if there wasn't all this hope in the market. But this leaves room for, even if he does that, if the market's already expecting a dovish hike, we could have a rally followed by a fall. And that's the one thing that I hadn't thought of until reading this. So I didn't cover as much as I wanted to. I didn't even get into the technicals, but I'm going to throw them up there so you can take a quick look at them. I don't have them. I have them closed off. But basically, it's kind of like this: above 1256, be friendly to the market. Below 1241, be not friendly to the market. Below 1233, look out below. I think there'll be some between 1256 and 1265. But again, if you're bullish gold, buy stocks. If you're a bearish gold, if you're bearish stocks, uh, sell stocks, and then sell gold tomorrow. That's kind of how it goes. But I hope this has been informative and educational in helping you prepare going into the Fed meeting, armed with some sort of a grid or framework of trying to understand stuff, and not saying, well, this happened because it's bullish, this happened because it's bearish. Just, it's a big gray area, and traders think that way. 829, gotta go. Have a great day, and please be careful and trade because you want to, not because you have to. Have a good day.